As you manage your taxes with both near and future in mind, one important constant goal will be reducing your adjusted gross income, or AGI, which equals your gross income, salary, investment, earnings, etc., after your allowable deductions and exemptions. Now, maximizing your deductions and exemptions, as well as taking advantage of your tax credits available to you, it's a great way of starting to save money on your next tax bill. Hey there, my name is Kenner French. I'm with vastsolutionsgroup.com, trying to make an exciting thing as taxes, just kidding, as exciting as possible. We're going to be taking you on a very brief journey to help you understand taxes just a little bit better, meaning specifically credits, deductions, exemptions, etc. Credits versus deductions. First things first, how is a tax credit different from a tax deduction? A tax credit reduces your tax dollar for dollar. That is, $1,000 tax credit actually saves you $1,000 in taxes. By comparison, a tax deduction reduces your taxable income, but it's only worth a percentage equal to your marginal tax bracket. Let's give an example. If you are in the 25% marginal tax bracket, a $1,000 deduction saves you $250 in tax, or 0.25 by 1,000, which is $750 less. It's a tax, and then a tax credit. The higher your tax bracket, the more your deduction would be worth. A tax credit is always worth more a dollar equivalent deduction. Tax credits reduce your tax bill, but certain restrictions such as income limits may apply. If you have a dependent child, you may be eligible to claim a tax credit worth a nice $2,000 for each child under the age of 17. Other family-related credits include the adoption credit and the dependent care tax credit. If you're funding a child's education, you may be eligible for what's called the American Opportunity Tax Credit, or AOTC, a still temporary version of the Hope Education Tax Credit. The AOTC, and by extension, the Hope Education Tax Credit, provides for a tax credit of 100% up to for the first $2,500, paying for 4 years of post-secondary education. All taxpayers must either claim a standard deduction or itemized deductions for personal expenses such as a home mortgage interest, as an example. Income limits apply to taxpayers who itemize deductions. In general, a taxpayer claims an itemized deduction when the total qualified deductible expense exceeds the deduction, or if the taxpayer does not qualify for the standard deduction. How is a deduction different from an exemption? I was just asked. Personal and dependent exemptions are reductions in gross income in addition to the standard deduction or itemized deductions. Every taxpayer may claim a personal exemption for he or she, unless he or she is claimed as a dependent on another taxpayer's returns. A married couple filing a joint return can claim 2 personal exemptions, one for each spouse. If one spouse has no income, that spouse is not considered the dependent of the other spouse for tax purposes, by the way. Exemptions will decrease for high-income taxpayers with AGIs above a certain phase-out threshold, depending. What's an above-the-line deduction? Well, retaining as much of your gross income as possible should be an ongoing objective, not something that happens only at a tax time. Above-the-line deductions, if you qualify, reduce your adjusted gross income. They are named because they are taken out of your tax form just above the line where you enter your AGI. What are possible deductions? They're included contributions to qualified retirement accounts, student loans, alimony, early period withdrawals, etc., etc. What are long-term capital gains and dividends? As an investor, planning your tax strategy can have a significant impact on your tax liabilities, particularly with recent law changes and updates. Concerning long-term capital gains rates, if your annual income is $0 to $40,000, the rate you pay on long-term capital gains, 0. If your income is $40,000 roughly to $441,000, it's 15, and if it's $441,000 more, it's 20%. Short-term capital gains are taxes at your ordinary income tax rate. Your dividends, if your income is $0 to $80,000, would be 0% taxes. If your income's $80,000 to about $500,000, you pay 15%. And if it's about $500,000, a little bit more, you pay 20%. Now, this was a brief, but hopefully worth it, video outlining how to understand tax credits, deductions, and the like. Once again, this is Kenner French of vastsolutionsgroup.com, helping you to become a little bit more literate as a financial entrepreneur. Thank you so much for doing business with us. We truly, really do appreciate your business.